Welcome, everyone. We are officially kicking off season 2, episode 1, and we have a very special guest today. He is Shawn Black, and Shawn is the co-founder and CEO of Happy Belly. Shawn, welcome to the show.
Hey, thank you very much for having me, Robin. Good to connect live.
Yeah, so Shawn, I was on a trip yesterday. I took my wife and my kid, my 7-month-old, to Port Credit, Mississauga. So we drove down there. We parked just off of Lakeshore, and the mission, obviously, before this interview was to go try out Rosie's burger. And so I get out of the car. My wife and kid are still in the car because it's freezing cold, right? It's like -10 last night.
Yep.
On my way to Rosie's Burger on Lakeshore, the first thing I pass by is Burger Factory. I look in Burger Factory, and there's no one there. I don't even see an employee behind the desk, behind the counter. It's completely empty. I keep on walking 3 units down, Rosie's Burger. There's about 6 or 7 people, and people coming in and out. I go in, and the first thing I think about, Shawn, I started thinking about the old Licks, right? As soon as you walk into Licks, you see all the guys at the front counter, like they greet you. You see the people, they're grilling, they're right in front of your face, right? Everything's there. It's nice and small. Everyone's saying hi and hello. It was a great experience. I ordered the OG Rosie burger, of course. I opted for the single patty, not the double. I'm trying to go for that 2005 New Year's resolution. And someone on X told me this. They said, you know what? One of their secret menu items, what was it again? The dad's banana pudding.
Yeah.
I was like, okay, why the hell not? Let's give this a try. We can cheat tonight. And it was amazing. It was an amazing burger. The dad's banana pudding was the most decadent thing I've had, I think, in over a year. So well done there. Honestly, well done.
Thank you very much. That is one of our, core pillar brands, within the company. The founders, Cactus Club guys, really know their stuff. 2 brothers, that really, and their dad, was involved, but the 2 brothers that are the face of the company today, Daniel and Dustin, great brothers, like great guys. One ran back of house Cactus Club, and one was front of house. So they really understand both sides of the business. They've now since brought their younger brother Isaac into the mix. He's learning the ropes and going to be another great piece. But those guys are built on what we like to call the 3 Ps, which is people, product, and process. A lot of their people that work with them are ex-Cactus Club, and they have they understand culture and they understand product, better than most early on restaurateurs and franchisees. They've opened, to your point, and there was also a Burger's Priest in Port Credit, which has since closed. Burger Factory's obviously not doing too well, and Rosie's is up significant double or triple digits, in sales year over year. And they are literally built on just the classics, right? So like you said, your big decision was, is it a single or a double? It wasn't. And, and then, yes, the dessert, which originally was just banana pudding. And then, I think out of respect for their dad who came up with it and was one passionate man about banana pudding, they updated it to dad's. So it's actually built off their actual dad's recipe. So it's a true story. And I think that's the best part of that brand is it's a true story. They're so real. It's almost unbelievable. You know what I mean? Because they've done that, and that brand now is expanded into Alberta. More stores on the way as we speak. It's going to double in size here very shortly as a chain, and they're just crushing it. So glad you got to try it. You did what we call the belly check, which is a big part of our business. We literally do it almost every single day, and Rosie's. What a hit for us.
Yeah, like who doesn't like a good burger, right? It was a solid burger. You've already run Burger Priest out of town, which is a little bit bittersweet for you because we'll get into that history later. And Burger Factory might be next out of the Port Credit area. How did you come together with those 2 brothers? Like, tell us that story, how Happy Belly ended up acquiring the Rosie's
Right.
Burger brand.
Well, you know what? I actually live in Port Credit, and so I'm very familiar with the brand, and but I never tried it. I was originally one of the partners that helped build and grow a Burger's Priest and sell it to Fairfax and Recipe eventually, which were our partners on that deal. And, so it was kind of always against my religion to go to another burger place. So I never went to Rosie's and never tried it. And then once we'd exited Burger's Priest, for a period of time, I had a non-compete. So I hadn't gone anywhere, I hadn't tried anything. And because, it just wasn't an area of interest. I wasn't allowed to play in that space. So eventually I did try it. And then first person I met was Dustin. And, and then I was like, wow, nice guy, and tried the food. And, and I kept hearing other people talking about it. And, I have a 3-time rule that I follow, an old Chip Wilson rule. And eventually it led me to try it again. And then, a chance meeting with Dustin, Daniel, and his dad. Tried the product. And to be honest, the first time I tried it, I didn't love it. And I shared that feedback with them, and I honestly thought that'd be the last time I ever heard from the Gelman family and the Rosie's guys. I thought I might have had to be picture up on the wall saying, like, not wanted, you know what I mean, after that visit. But believe it or not, a couple of weeks later, after that feedback, pretty harsh feedback, I remember leaving the restaurant with my business partner, Alex, saying, what do you think? And we were like, I like the people, but not crazy about the product. Love the process. So missing one of the key 3 Ps. And a couple weeks later, Brian, the dad, gives me a call and says, Shawn, will you do me a favor? Will you go back down to Port Credit and give it a try again? Sure. You know what I mean? You're a glutton for punishment, I guess. Like, so I go try it. And I'm like, holy crap. What changed? Like, this is excellent. So I called Alex and said, Alex, you got to get down there and you got to try this. Like, they've completely changed what they do. Like, this is a new burger brand. Like, I can't even believe it's the same place. So go back and said, what happened here? Like, please explain this to me. And I met with the guys, and Brian's like, oh, thank goodness, Shawn. So the boys took it to heart. They put pride aside and everything aside. They want to win. They wanted to create the best burger. They wanted to do really well by the brand. They ripped out the freezers. They went to a fresh product, started changing how they do things, all because of feedback they received from me. And I was like, at that moment, I said, I got to do whatever it takes to be partners with these guys and help foster that energy and that passion and help them build this into, an unfinished story that I had, which was the best national smash burger chain in Canada. So
That is
that's
awesome.
when these guys are incredible people. But believe it or not, right next to that is their brand. And this is a family affair for them. And that brand is, like I said, experiencing great things. And it's all because of the 2 founders. Dustin and Daniel are great.
And the Gelman family, they're very much aligned. Like, they're still on board. They're helping to roll out new stores, right? New locations.
Absolutely, yeah. Like I was just at the Calgary opening, which was a huge success for us. They even had Isaac with them. Like, those 3 guys were sharing an Airbnb together and, working their butts off. You know what I mean? Honestly, that's what they were doing from, 8 in the morning till, 11, 12 o'clock at night. Every day, those guys were in that restaurant. I was there with them at Calgary and so happy to see what they were doing. And now we're about set to open shortly here in Burlington, Hamilton, then on the Avenue in Lawrence in Toronto, and then at Shops at Don Mills, our next one in Calgary. And then they got more coming right behind that we're actively in motion on. Those deals are already in motion. So amazing to see, that the brand's going to go from the time we met them at 2 stores that were kind of bumping along, moving their, doing okay, probably made money one month and didn't make money. Now they're, now they got a bank account balance problem is what I would say. You know what I mean? Because their business is very profitable. They're opening net new units. Key here too is the next couple of stores that are coming. They're going to be opening them with free cash flow that they're generating from the business.
Wow.
So they're going to be debt free, cash flow positive, and adding assets to the portfolio, all from free cash flow.
That's
Amazing.
amazing.
Yeah, and in probably in 18 months, that's what's happened to that brand since we joined them.
It's a homegrown success story. You saw it could be successful, that it could scale across the country. It's going to scale. It's going to be a household name soon, I think. I'm sure it'll be. So after I had the burger, drove down, wasn't very far, like a minute, east along Lakeshore, and stopped off right outside of Heal Wellness. Walked in, and totally cool vibe. There was like a surfboard there by the counter. again, greeted with a friendly hello. And the acai bowl is amazing. I had the OG acai bowl, I had the, peanut butter on top. Again, this is all part of the research process.
Yeah. The belly check.
And I've had oakberry before, Shawn. I found with oakberry, it was just like loaded with sugar, right? But Heal, it's very much like just like the raw goodness of the ingredients, right? And it was great. It was bigger than oakberry as well, same price. So well done there. Can you tell us the Heal story? How did you end up acquiring that brand?
Absolutely. And to your point, yes, I believe when you look at the players across North America, that guys that have sold for, one of them just sold for $2 billion in our space called Tropical Smoothie, with about 1,100 stores, to Blackstone. If you look at the category today, Playables, Everbowl in the U.S., Booster Juice in Canada, the same thing comes into place. It's and when at the base of one of those key three P's is the product. That product today is by far the best acai base that I've, and I didn't create it, so I'm not saying I'm trying to take compliments for that, but I believe it's the best one I've ever tried. And that is the foundation of the business is the product. And so their product, I believe, is a winner. What happened there was my business partner's daughter's heavy into dance and stuff like that, and they're, she's spending time in Hamilton, and very connected, from social to that kind of stuff. My business partner kept hearing, Alex, our chairman, kept hearing about this brand that had popped up in Hamilton. And next thing you know, Alex is driving his kids there all the time and their family. And he calls me and says, Shawn, I think there's, might be something here. Like, why don't you, do you want to take a look at it? So I dug in on it, called up, met Jay and Jesse, the two co-founders, and their partners, Ryan and Kartik. So there was four partners in the deal that had founded. Ryan, I think, actually was one of the key ones that fell in love with the category, and Jay and Jesse put it to use. Jay's former health and wellness space. Jesse is the operations, the marketing, the strategy guy, and looked at it, and they put that brand together. They'd opened up 2 stores, one in Hamilton and one in Guelph. We looked at it and said, you know what, like the people, like the product, think you could improve your process, which included real estate decisions, included scaling it, how you do it, put a little bit of capital behind the company. And I think you could have something here. And I think you got a best-in-class product. Now we need to, build the team and build the foundation. And that's exactly what we've done. We started with 2 stores. That brand now today is 14 stores open. We've got 100 and just over, I think about 102 sold. That brand is now in Ontario, Alberta, BC, with an LOI for our first stores in the US, first 10 in Florida. And we believe that brand should end 2025, somewhere between 30 and 40 stores open.
That's exciting.
Incredibly cash flow positive. They have I think $120,000 or $150,000 of debt total on the company. It's incredibly cash flow positive. And Jesse is again getting on a plane this Sunday, heading out to a third opening in Edmonton, which is at University of Alberta. Very, signature, high profile, another piece of real estate for us. So we've applied our pieces to a great team that had, in my opinion, best in class product. And for us, we can stand behind that. When you got good people and you believe you have, if not the best, one of the best products in the category, then it comes down to execution. So I'll give that one to Alex and his family. They found it in Hamilton. We jumped on the opportunity, and now we are on our way, in my opinion, to being the leading, smoothie bowl product brand in Canada.
I love it. So Happy Belly is basically a machine that helps to scale good product, good food.
Yeah.
With systems and processes, etc. Is that your first foray into the US for Happy Belly? Is it through Heal?
For Happy Belly, yes, Heal is the one that we are targeting as our first brand.
Okay.
Previously, through Extreme Brands, we had an office in Scottsdale, Arizona. We had opened about 50 restaurants in the US, and that was at the time we transacted and sold the company to MTY.
Mm-hmm.
And for people that know the MTY story very well, back then they had no presence in the US. Stanley felt they were a little over-concentrated in Canada. They were at risk here. So he was looking to diversify their real estate and their holdings. He wanted some U.S. exposure, and he wanted more street front exposure. So when they acquired us, a big part of that was for their U.S. entry point. So they used our Arizona office as U.S. entry. Today, if you look at it, MTY, let's say they do $1.5 billion a quarter. I believe 60 to 70% of that revenue is now U.S. derived. So Stanley was right when he acquired us. That decision was well timed. He needed people and product to enter the U.S. and process, and we gave him that. So it's not our first, personally, it's not our first foray into the U.S., but for Happy Belly, that would be our first entry point. And for anybody that remembers, MTY trading at $18 to $20 a share back when they did the deal with us. Very quickly it became, $35 a share and, on its way to, I think, about 74 at its peak. So Stanley was right. It was a great timing for them. And yes, this is us putting our toe in the water. We're doing a crawl, walk, run. But Heal is going to be potentially the first North American brand. If not, it is already the first national brand in our portfolio, but it's becoming a beast real quickly. If that brand gets us to 50 to 100 stores over the next, let's say, 12 to 24 months, considering, that it'd have a 7-figure EBITDA number, free cash flow, it'll be debt free. I think that's pretty good from when we found it, like 20, I'm going to say, I think about 20, today it's probably 26 months ago sort of thing. We found that brand 30 months ago. And, it was basically break even and, a little bit of profit, but, a little bit of debt, a little bit of profit and trying to find their way. Pretty good story 36 months later, I think, if we get to that point.
That's a massive win. And is it a case where it's just one franchisee in Florida who's rolling out all those 10 Heal locations?
That's right. And we're also working with another group now in Florida as well that are on the West Coast. The first group is between kind of Jupiter and Fort Lauderdale. We've had franchise interest in, let's say from over the time, like multiple different states. But we're we're going to ideally go deep in Florida first, go mile deep versus mile wide, and trying to expand that market as our primary launch point. And ideally for us, if we can get one brand going there, then we'd probably go with a second brand and enter into the same market, use that market knowledge, market intelligence to win again with a second brand.
I love the strategy with, your foray into Florida because there's synergies, right? You have Canadians, you have snowboards going back and forth, right? Snowboards.
Yeah, I had a host there for a long time. So and Alex still does. So, we do spend time there and we got pretty familiar with the market. I think it lends itself well to a couple of brands we have, especially based on competitive set. And, like it's warm there probably, 350 days a year. So, a smoothies sell better probably in February in Florida than they do in, I'm going to say, Fort McMurray. You know what I mean?
People are going for the double at Tim's, right? In Fort McMurray that time. So the third brand that I want to visit that I didn't have a chance to is Yolk, the brunch place.
Yolk.
Where can I go to visit Yolk?
Well, right today, Yolk's is in Vancouver-based brand. Ottawa will be the next one opening. Yeah. It'll open end of Jan, early Feb. Just waiting on equipment delivery and final setup. But that store's ready to go. And then working on the first GTA location. So we're working on Oakville. We're working on Tobico, Hamilton. So Mississauga we're working on. So hopefully in 2025 we'll have our first GTA location open. But that's a great story. That brand. That's the chef there. Former, worked at French Laundry, one of the few 3 Michelin star restaurants in North America. Ran his own the top restaurants in Vancouver, made a lifestyle change for family and wanted to be home for dinner. Went and opened, what I consider to be the number 1 breakfast brand in the country. Probably their biggest competitor would be OAB. But I personally like the setup and the vibe a little better and the people better at Yolks. And so now it's in motion. So we have them entering Alberta, working on locations today. We got LOIs out in Calgary. So Alberta, Ontario, BC, and I've just been in Quebec a couple times. We've identified our first real estate. We're just trying to get it over the finish line. So that brand should go from being a one province, local brand to now going deep in BC, and as well as Alberta, Ontario, and Quebec. I would expect us to all be open in 2025.
Happy Belly is very much in growth mode. And I know that you mentioned part of that rollout strategy. Ottawa is next for Yolks. This is a good segue. I think you're from Ottawa. Is that right, Shawn?
That's right. Yeah, that was my first area. Opened my first restaurant just outside of Ottawa in a town called Arnprior. And
At
then
the age of 19, is that right?
what's that?
Like 19 years old. You were that young. You
Yeah.
opened up your first restaurant. So like, tell me how that happened, because that's a big risk to take on. How did you know to do it? Were you a foodie? Were you operating in the
You know what?
industry before?
I started in business working when I was 14.
Wow.
And one thing I liked at 14 is I wasn't afraid to work to make money. And at home back then, I had to, pay some rent, and I had to help contribute into the family bills. And responsibility was, kicked into my butt early. And I had no choice back then. And so, at 14, I'd worked at this kind of little cafe. It was a small town version of Tim Hortons, playing junior hockey, and, really got to, had the bug for hockey. But to play summer hockey where I grew up, you need to help contribute to that, even though I had a sponsor. Back then, Frisbee Tire in Ottawa, I remember they sponsored me. But they came along and said, listen, like, we can't afford to help, all the hotels and the travel and stuff like that. So I had to help contribute. So to do that, I went and got a summer job. And during that time, it was a little spot back then called Aunt Sarah's, a little donut shop. So that's why I got my first taste of restaurants at 14. Worked at Pizza, worked at a couple other places all through high school. And then when I was 19, my old boss was making a life decision to sell off one of his stores, or, figuring out something because he couldn't do the travel and operate multiple locations. Happened to be the one in Arnprior that he was willing to part with. And he came to me, and I worked the deal out. So I took over the business when I was 19, accelerated the business, drove the sales, heard there was an Arnprior potential of Tim Hortons coming to town. So I was like, maybe a good time to sell, versus, and see what's next. So I sold the business, kicked around for a year, 2 years, and said, what am I going to do next? Came across this small little Pita concept in Kingston that had opened up called Pita Pit. Looked into it, didn't have the opportunities I was looking for in Ottawa. Came across this other 2-store chain called Extreme Pita. Met the guys. They just opened their second store. They're working on a third in Hamilton. And then third one opened, but by the time I got down there and went to look at a Pita Pit location, actually, and met Alex and Mark. Became my two business partners. I was in my early 20s, and I started off as a franchisee with Extreme Pita. So that was my first franchising experience post working at Pizza and a couple of locals. But at 19 years old, going to high school, back then I was making great money. That was, and I was working, pretty much every day from 4 till midnight or 4 till 2, depending when I got let go at the, nighttime to go home, and I'd be back at school the next morning. And, so it was an interesting experience at 19 years old, watching your friends all come back from university at, break or Christmas, or, during summer. Our restaurant, my first one, opened up at 6. So I'd be in there every morning by 5:30. And, my buddies often were just coming back from the bar, or just from one of their houses. They'd stop by for, a cheap meal, or a free meal, before I opened. And, it was a great learning experience. So I'm very fortunate that, at 19, my first original business, I changed the name to Apple Sarah's. It was known for its apple fritters throughout the Ottawa Valley. And then, Ottawa, my first Extreme Pita, I opened early 20s at Bank in Albert, right downtown. I was supported. I remember looking in at the front door and seeing some of my early friends, Billy and Ryan Marcellus, and, Corey, and my friend Steve Stiles, childhood friend, came and helped me do the demo. When my father-in-law was there with his truck, helping me get started. Because back then, it was just, I didn't, they were borrowed shoestring budget for my budget. You know what I mean? There wasn't, everything was on my credit card and stuff like that. So yeah, that's what all got started back in the day in Ottawa. And as the business grew, I became the guest that never left. I think my business partner's parents' basement. I took it over, and that became our office, and where I lived for the first number of years while I commuted back and forth to Ottawa. So Mississauga became our home base years into the business, but Ottawa up until mid-20s was home for me.
That's super interesting. Are Mark and Alex from Mississauga? Is that
Yes,
the
they are.
origin? Okay.
Yeah, they're both Mississauga. Alex still lives in Mississauga. Still are based out of here. He's Oakville now, but Mark, our partner's in Montreal. He found love, and love led him to Montreal.
Montreal's a
So
beautiful city.
yeah, so he still lives in Montreal,
Cool.
and both of them are on the board. So the team has stayed together since.
Yeah, it's been a lifelong partnership, right? Since I think '97, I believe, right when you first
Yeah,
started that franchise.
that's right.
And Extreme Brands was highly successful, obviously leading to M2Y buying you and then buying you out in full. How many Extreme Pitas did you roll out eventually over that,
We
let's
had,
say,
I
13-year
think at the
period?
time, we had about 230 Extreme Pitas open. At the time, we also had Mucho Burrito, which was the second brand we launched. We
Another
sniffed.
highly successful brand, right? It was basically in every food court at one
It
point,
was,
right?
and we're
Yeah.
very lucky. That one we sniffed out early as the early movement in Mexican. I was literally getting, as we started to expand, doing U.S. entry for Extreme Pita. I probably went to 30 different states, looking at all the major markets, all the major campuses, where we wanted to be plotting our entry. And during that time, I found myself every time I get out of the car, I get to the airport, I'd go to log on, I'd get in my rental car, and I'd hit a Hertz Never Lost and put in burritos. And I'd be going to, back then, Legal Pete's, if it was Colorado based or Boulder, phenomenal. I'd be going to Qdoba in Wisconsin and some of the markets where they opened. Then I found Chipotle when there were like 70 stores.
Oh,
When I called them all and said, "Hey, like this is incredible. Would you guys sell us the rights to Canada? I believe, fresh Mexican's going to be the next thing." Alex showed it to him. He freaked out, said, "Yeah, this is amazing." He's like, "Black, go get it." So, we tried, and every one of them giggled when we called. They literally thought we lived in the North Pole. And they're like, "Where's Canada? Sorry," like click, because they were just getting started in the US. So, funny enough, as we launched Mucho, got Mucho really going, and because I believe there's a huge piece to have first mover advantage, and I thought we could get Mucho to 100 stores before any other Mexican player in the US came in. We could have the best real estate tied up in the country as our strategy, and then we had a defensible brand, and it proved to be right. And it was the most at that time the most successful brand we'd ever launched. Incredible average unit volumes, franchisees making money. So we had about, I think, 75 of them open on our way to about 85, 90. When we sold it to MTY as a chain, it was, say, 320 some open, about another 60, 70 stores in the pipeline. So about 400 stores total, including pipeline, that we sold to MTY early on. And that led to me becoming their chief development officer at MTY. But yeah, those are our first two entries. Identifying an early growth category is something that, we've kind of had a knack for, because we like finding what we call emerging brands and emerging categories and capitalizing on that, and using our team and our experience, our relationships for access to real estate. Because we're a small company, we still act very entrepreneurial. We're able to move quicker and beat out the big guys. Some of them take 3 to 6 months to move paper through their office and just to get a site. We can get a site signed the same day.
that's so cool. Are there any categories that are gaps in the Happy Belly portfolio that you want to fill?
Yeah,
Any emerging
I
trends?
think if you look at some of the staples in the North American diet, burgers are one of them. We touched on. I think breakfast is one of them. I think we're playing in a couple of categories like that. I think there's emerging categories. One of them we touched on, which is Pyro, which is a direct competitor to Cava out of the US. I still believe pizza's there. Pizza, and so that we do sell it at Via Chivo, but it's predominantly, our sales mix is predominantly pasta. So I still believe there's opportunity for pizza. I still believe there's opportunity for coffee and beverage. I don't think that's well represented in our portfolio.
Mm-hmm.
Still think there's opportunity for, I'm going to go out and say, not necessarily Mexican, but I think if you look at the emerging categories of, I'm going to say Indian, I'm going to say, the Peruvian categories, there's other parts of the categories that aren't touched yet. So there's still, I'm going to say Portuguese. There's, there's still other European categories that are underrepresented that I think they're going to be a player in the space. One of the ones we just recently launched was Caribbean. Because today, if you look out there, there's no national brand in that category.
Just single
You see,
locations, right?
looks like
Independently
you're
run.
seeing there's a brand out of the U.S. that's growing in the Hawaiian category. So people are sourcing out different types of cuisine to eat, and if they're going to leave their house, you got to make it worth it. You got to provide a good experience and good value. So that's what we sort of search out today. And one of the biggest things we do, and during that process, is we do the belly check. We try the food, and then part of that belly check is the people. Then we look at their unit economic model. Meaning if because usually for us, that's where there's a little less risk is when you find a brand that already has proof of concept, which is 3 to 10 stores, then all we have to do is come in and enhance it. We don't have to build it from scratch. So we can save years off our lives by, and mistakes by going in and finding a brand that already has great numbers or good baseline numbers, but we believe with our team, we can accelerate those numbers. Exact example, which is Rosie's and Heal. We do like doing that as well. We've done it with Lettuce Love out of Burlington. Same thing. So unit economic model for us is the third step, and I'll compliment Bill Gregson, who is the turnaround specialist and one of the top guys between Fairfax and Recipe, and Paul Rivette. Both of those guys were our previous chairmen. If you want to understand people that are agnostic, the only thing they trust and respect is a P&L, that's Fairfax. They are incredibly disciplined. So being able to work alongside those guys for years, having Paul, who was the longstanding president of Fairfax, as our chairman, those guys will teach you operating discipline like you've never seen before in your life. I compliment them all the time. Like I sent Paul a note a while ago and said, Paul, I thought I knew a lot when I joined there, and I was I probably came in elbows up a little bit because, after being at MTY and building my own brands with a team and exiting them, and doing pretty well in the space. That saying of you don't know, you don't know. I realized I didn't know a lot, and Fairfax taught us a lot. So I thank them for that, and our shareholders today of Happy Belly benefit from those experiences.
Yeah.
Because man, those guys are disciplined. They are they love numbers, and if the numbers don't work, you don't do it. And that's I think if you see the way we, I compliment how we do our M&A today to Stanley. Stanley's the best I've ever seen. If you look at the track record of MTY, from say 1978, 79, when they were, pennies, till they took off. And he was there until 2019 as the CEO. That is one of the best compounding stories I've ever seen in Canada. And by far, the best compounder in the history of QSR in Canada. Nobody's ever done it better during those years, up till 2019. And that's strictly based on his M&A discipline. He was incredibly disciplined. And if you ever take then what Fairfax is good at, which is operating discipline, you ever bring those two things together, I think you can do better than MTY ever did.
Exactly. So there's a nuance in what you said, Shawn. You said up until 2019 for MTY. So what lessons are you taking from post 2019 MTY to Happy Belly now, and how you roll out M&A, everything else?
Yeah, there's some things that changed at MTY when Stanley took a step back from being the CEO and became just chairman. If people were to look back and look at their debt ceiling, how it went from, typically in that, I think it was about 150 to 250 million sort of thing. All of a sudden, went 300 million. And next thing with debts and liabilities, it was 750 million to 900 million in their debt facility. And they went outside the box on some M&A. And Stanley typically paid 4 to 6 times from everything that I, witnessed and was part of. His core deals were done at 4 to 6 times. Eric came in and, made his own play, and went and did a couple deals. I believe one was, 2 biggest deals that took their debt facility up, especially in USD when they bought them. Paid 9 times for one, and I believe 12 times for the other. And that was to close those about 2 years ago. And I think if you look since then, over the last 2 years, I don't think they've done an M&A deal because you were highly leveraged in a time where I think debt was not loved in the market last couple of years. So I think doing high leverage deals, paying outside the box multiples, twofold for us. When we do an M&A deal, we want to be able to double the EBITDA within the first 24 months of any M&A deal. When you look at a deal that's a big one, if you buy hundreds of stores and you're going to bring it in, it's very tough to double the EBITDA on a deal like that, right? You're buying something like that at that point in time. I mean, if you could grow at double digits a year, I think you're ecstatic. I think for most types of M&A like that, you just hope the bottom doesn't fall out and same store sales don't go down. You don't have a negative store count, and then your multiple goes up, and your risk profile on a deal like that went through the roof. I listened to an interview you did the other day with Mr. Rochon from Gaverny. Obviously a very intelligent man and very disciplined. And I think if you want to stay in this business long term, look at what Fairfax has done. Look at what Mr. Rochon has done at Gaverny.
Yeah.
Look at what Stanley did for years up in 2019.
Yeah.
You want to stay in the business, you got to stay disciplined. You got to respect your partners, which are your shareholders and your operating partners. You got to do right by people. No silly mistakes. If you want to be a long-term compounder, discipline is going to play a part of it. So what did I get from both of them over time? From MTY, from Stanley, I got M&A discipline. And then from Fairfax, 100% I got operating discipline is where I learned both of those things. And that's the key. And I believe from Eric has probably learned from it today. I bet you he probably doesn't make the same mistake the third time. He made it twice. Hopefully he learned from those two and doesn't make it a third. But I think the share price has been punished, and their numbers have been punished because of the risk profile that they went to. They were always a heavy cash buyer, reinvesting free cash flow. I don't think the market loved their high debt, much lower return per share ratio. And I think they've lost some trust in the market, and that's why their share price is down. Now, in fairness, that's the opportunity for us. We don't have today. I think we have, we talk about $900 million debt facility. Today, we're operating with, I think, $180,000 of secured debt on the business. It could be, it's around that number. So without that high leverage, and that's the opportunity. As we continue to grow and move towards earnings per share positive, which is kind of the holy grail in the business today for institutional clients, investors. That's where we want to play, and we want to be reinvesting capital. Want to be good stewards of capital from our shareholders and our partners, so that we return more money to shareholders. That's what we want to do. We want to be a growth story. And I think the moment you take growth out of your story, both same store sales and net unit count, as well as ideally brand count, that's the opportunity. I believe we're going to capitalize on that significantly over the next 12, 24 months.
Yeah. And the MTY story, I think going back to your 3 Ps, the recent acquisitions probably weren't a good product fit at all, right? I think one of the acquisitions in the US by MTY was a frozen pizza company. I think it was.
Yeah,
they
did a big deal like that. Yeah.
Yeah, it was a big deal. But like the beauty about, you and your vision and Mark and Alex's vision with Happy Belly is that you're looking at the growth opportunities, looking at the future, you're looking at catering to millennials and Gen Z, and you absolutely are, right? They're not going out and buying frozen pizzas.
It's definitely a different category. I think it was Papa Murphy's that they acquired. Yeah. I haven't followed the numbers on Papa Murphy's to see, whether unit count has grown or shrunk since they acquired it. But the biggest thing we're looking for is low risk. So when we started and you buy a brand at 5-10 stores that's cash flow positive, debt free, I don't see a lot of risk there. You know what I mean? Like, it's a low risk, high reward. And think about it. One of the brands we acquired, let's say it's a Heal. We acquired 50% of the brand for $125,000 in shares. And now, if we are all of a sudden in a position where down the road that brand has 100 stores, let's say it's worth at that time, I don't care, 20 million, 30 million, 50 million, whatever the number is, it'll be based on, earnings. But let's say it is. That means we bought something for, let's say total investment cost might be somewhere between $1 million and $3 million. And I created somewhere between 20 to 50x return on for investors. On the first investment of the first 50% of the brand, $125,000, and you sell something for 30 to 50 million, you're talking, between 30 to 100x and return on invested capital. That's what we're focused on. I think there's way more upside for us in doing those deals. But the big part is you have to have a team that has the ability to grow. When Fairfax came to us, they said, Shawn, listen, Recipe at the time, it's not built for that. Like, we want you guys to be the emerging brands division. You guys build the brands to 50 to 100 million in system sales and then vend it into Recipe, and they'll execute at scale, which makes sense, right? So they said, but we don't want to incubate. We don't want to, spend the time and money to try and take a brand from 2 stores to 50 to 100 million in system sales. So where we play is in that $1 million in system sales to $50 million in system sales.
Yep.
I believe the rate of return the risk is higher, but the rate of return is significantly higher for us, to do that. And for our shareholders than it is for us to go buy a brand today that has 50 to 100 stores and hold the prey. That the bottom doesn't fall out, and we can grow it by 10, 20% a year. That would be phenomenal growth for a mature brand. And most brands today, I spoke to a gentleman from the other day from A&W. I said, what are you hoping to do this year? And he said, well, our budget's 4%. And I said, okay, do you think you guys will hit 4% growth? And he's like, hell no. And I was like, oh my God.
That's a low goal, right? Very low.
It's a long ride. It's a long grind. Every year, add a few stores and try and get 4% growth. I'm not getting out of bed for that. Like, it's not, it doesn't move the needle for me. It doesn't interest me. When a brand gets to that kind of slow, mature growth, we'll sell it to one of those guys. I'd rather be over time at this company, 10 to 15 brands and going deep into a category versus going wide. So you touch on Rosie's earlier. Likely down the road, if we ever add another burger brand, we'll likely buy it and convert them all to Rosie's. So that would increase our footprint in the category, get us scale quicker versus, M2I. Back then, they ended up owning multiple Thai concepts. I prefer not to do that. I'm not saying it's wrong. It might have worked for them, but I don't want to own Thai Express and Thai Zone. I'd rather pick one of them, own that brand, and change all the banners on the other ones to the same thing and dominate. I think that's where we'd like to play. That's our vision. That's our differences between us and M2I. And because of our capital and where we sit, and because of our strategic partners, we're able to execute on the plan in front of us today. And I think
that's fantastic. So just so the timeline is clear to the viewers here, from 97 to 2013, you're in growth mode with Extreme Brands with Mark and Alex. You've opened up over 200 Extreme Pitas. You sell that whole group to M2Y Food Group 2013. And then you're absorbed as well, Shawn, naturally into M2Y Food Group. It sounds like you get bored within a year, you, Mark, and Alex, and you want to go back into growth mode. So your non-compete kind of goes away. And then in 2014, you, Mark, and Alex launched, I think it's called Crave It. Is that right?
Crave It Restaurant Group, yes.
Can you tell us about Crave It and the brands underneath that umbrella?
Yeah, absolutely. You know what? Crave It was launched really as the 2.0 of Extreme Brands is really what it was. Take the experiences that we had in Extreme Brands. So, okay, what spaces do we want to play? Where's the open ice today? And, we had, I had a chance meeting along the way. I was out in Whistler for an event, doing a speaking event. And believe it or not, I'm not a big fan of public speaking. That was probably the only day I was ever sick all through public school. So, this next thing you know, I thought I was going to be speaking to 1,500 people. And next thing you know, this auditorium is packed, and I'm having lunch and I'm chatting with this one gentleman, and this group is there, and there's a gentleman from Rogers, and I think a gentleman from Cabela's speaking first and second. I was speaking third, and there's this gentleman beside me. He's going up fourth, and next thing you know, there's this breakfast television lady, and they're miking us up, and there's lights coming on, and I'm like, okay, this place is packed. I'm starting to feel sick. I'm all of a sudden, my temperature's going up, and I was thinking maybe I gotta go. And I'm like, where's this crowd coming from? Like, I don't understand. And anyways, the gentleman who was speaking fourth was, there, and starts talking about what he did early on in his career and stuff like that. And I was talking to him, and I'm like, I'm looking at this guy, and I'm thinking, recognize you. Like, what'd you say your name was? And he's like, Chip. And I was like, Chip Wilson? And he goes, yeah, what? And I was like, oh, it's your fault to this crowd. Like, you're the jerk that brought all these people in.
Lululemon guy.
Yeah. So, you know, and I got to listen to him talk and how he, you know, he spoke to people and how he broke down the business and how he built and, you know, Lululemon. And I was thinking back then, I was like, oh, you're the guy that I see every month on the credit card. You know what I mean? Lululemon. Because back then it was predominantly a female brand. It was never a male brand. Like, you know, I kind of giggled. And the first time I, you know, probably bought my first Lululemon stuff, I probably didn't want to tell anybody, and none of my buddies anyways, because they would have teased me for sure. Now I predominantly almost all my clothes are Lululemon. So
Yeah, they're just too comfortable, right?
yeah, it's just such an everyday wear, and I'm not a big dress clothes person. So needless to say, I learned a lot. Chip told a story out there called the 3-time rule, and that was one of the most impactful pieces of, you know, experience / business advice I've ever had in my career. I've had a few from Bill Gregson. I've had a few from Paul Revette. I've had a few of them from other people, but that one was huge. And he said in a short period of time, you know, that's how he created Lululemon. When his people were coming into his board shop in Kitsilano, he kept hearing, you know, people saying, oh, you know, I hate that I smell and I want to go do something after, but my clothes stink. So Chip
Yeah.
said, so he went out and created a technical sports garment so that it wouldn't smell. And he goes, believe it or not, it was his wife that, you know, I mean, at the time that made it, you know, look great on ladies. And he paid her a lot of respect in how he spoke. And he goes, yeah, I get to do the interviews and I'm doing all the above, but it was actually my wife that made it look great and made it, you know, be part of the everyday life for ladies. And I thought that was a great story. And I said, so if he hears, and so he's done about 20 different businesses based on the 3-time rule. So what he calls, if there's influencers in a space and they're all looking for something, or if he sees a need, he'll start to dig in. So, you know, I'm on the flight home from that event, and this one of the real estate brokers beside me. And normally after 3 or 4 days in Whistler at a corporate event, you know, you just want to sleep. For 5 hours, I'm listening to this guy talk about this one location that had opened up and how amazing it is. And it's this new burger spot and the lineups are crazy. It's in Toronto. Heard about it again shortly after. Heard about it again from a good friend and it's in the business saying, yeah, that place is crazy. Product's excellent. I was like, okay, 3 times in a very short period of time. I walk into the office beside me, Alex's office, and I go, Alex, we got to go try this burger brand and that opened up in the beaches in Toronto. He's like, get out of here. Like, he's like, the last thing this world needs is another burger brand. Like, and, you know, for about a month, I'm bugging him, saying, come on, you got to come try this thing. He's like, buddy, get out of my office. Like, that's, you know what I mean? No way. So finally, I think one Friday he comes in, I probably, you know, had a couple glasses of wine or something the night before and needed some grease the next day. And he goes, that burger brand, let's go try it. So we literally used Chip Wilson's 3-time rule on that brand. Went out to the beaches. Lineup was ridiculous. It was probably 50 people deep outside on the street. Wow. This is after it had been open for a long period of time.
Yep.
And finally we get in, you know, Alex is getting bumped, you know, getting pushed, you know, but yet again, we start eating the burger and he's like, Black, this is incredible. Halfway through the burger, he's like, do whatever it takes, go get this brand. So, you know, introduced ourselves to the founder. We had a mutual, our broker that did our real estate did his, so we made the introduction. You know, a year later, we were partners in growing Burgers Priest. Thanks to Chip Wilson's 3-time rule. I used it as well again when we did our partnership for the next brand that came into Crave restaurants, which was Fresh Restaurants, number 1 plant-based chain in Canada by far, based on, I think, customer feedback, unit count, and also unit economics. Absolutely incredible. So when we looked at it, we said, okay, what would be a great way? Should we grow this? It's going to be a little more capital intensive. So we talked to Paul at Fairfax. We sat down with Bill, who was the chairman at the time of Recipe, on behalf of Fairfax. Said, Paul, what do you think? He goes, yeah, you know what? Bill looked at the numbers and said, he closed up the deck and said, Shawn, what do you need? Like, we'll be your partner. We'll write a check. So we did the partner. We partnership with Fresh. We grew that brand. And then as part of Crave It, a few years later, we grew those brands incredibly profitable, Burgers Priest, debt-free, just a killer. And we sold the remaining interest to Fairfax and Recipe in summer of 21. So that was, a big part of Crave It. Then the last piece of Crave It was a brand called Via Cibo, an Italian fast casual brand that we had built from scratch. We vended that brand after time. We vended that brand into Happy Belly.
Okay.
And so the remaining assets of Crave It were vended in. We did an all stock deal. My partners and I just took stock, rolled in a debt-free, cash flow positive asset to Happy Belly, and it became a cornerstone piece of the portfolio. So that's what brought it.
Awesome. So Happy Belly is the third rodeo for you and your partners, but there's a new entrant. It looks like there's the other Shawn Moniz. Can you tell us about his background and how he became involved in this third rodeo with you guys?
Yeah, along the way, I had the investing bug and was, learning along the way, and existing shareholder, Remy of Happy Belly back then. Sorry, it was called Plant and Go. Calls me and says, "Hey, Shawn, I want to introduce you to this company, and maybe take a look at it. Maybe you could help, and give some feedback on it." And I looked at it and said, "Oh man, this is brutal. Like, run." Remy, and he's like, "No. Like, he's a good guy, and you know what? I got money invested here. Like, I think we can do really well here. I think there's something here." So, we just got acquired by Fairfax, so we were free agents. I was like, okay, so now what next? And I was like, looked at it and said, like, only way I'd ever consider this thing is if you basically change what you do. You're really in a niche category. Yes, we just sold one of the best plant-based brands in the country. So I understand plant-based, but it's still niche, and yes, it's growing significantly, but it's still niche. So you need to become agnostic. You need to the food category. You need to become disciplined. They were not disciplined before I joined. The IR spend was significant. They weren't investing in profitable businesses. They were investing back then, I believe, in hope. And the hype of categories, it was all hype. It was driven. It was never based on business fundamentals, because I don't believe some of those early assets there was ever a possible path to profitability. Even with the best intentions, I don't think there was. So we struck a deal to fund Plant and Co. My partners and I and a few other investors, we put some money in our own personal funds. We created a platform to be agnostic to the food space. Over time, we changed the name to Happy Belly Food Co. So Shawn and I were the two kind of in the business every day, first two in. So that's where Shawn always says, "Hey, you co-founded this thing with me." Happy Belly, yes, but the overall story, no. What I felt early on about the company and what attracted me to it was, I did like plant-based. I did believe it was going to be part of the future and part of the story. I just didn't believe it was going to be the lead, story. But I like Shawn. I thought Shawn was a guy that, was wanted to do well by his shareholders, cared about, his family investment. And they had, he owned some shares at the time, not a crazy amount, but he was a guy that's willing to bust his ass off for shareholders, work hard, day, night, weekends. He cares. But he needed help. He needed some guidance. He needed some support. And some capital. So we did that. And along the way, believe it or not, as I think his confidence grew and his family's confidence grew, they went from, I think, about 2 million shares to today they own probably, I want to say 18 to 20 million shares as a family. So, a major portion of the company. During that time, we've taken insider ownership from 2% to 25% in the company. We joined originally, my partners and I, originally they joined the board as more of an advisor. Then I joined full-time in summer of 22. I think it was June, July. I joined full-time. So we're just rounding the clock here to 3 years ago. And we changed the name, Happy Belly Food Group. We went and did our first blocks of M&A. We started doing disciplined, emerging brand type concepts. We have 2 CBG brands, and we have today 9 QSR brands. And that's where it really started. We formed a team that had an idea, and it was going to take money, time, and discipline to execute on. And that was summer of 22.
Interesting. And you absolutely have skin in the game. You have around, I think, 3% share ownership, right, in the Happy Belly group.
I
So
do.
obviously you're bullish on the company, you're leading it, and you're aligned with shareholders.
Yeah, you know what? One thing I said right from the start is, if we're going to do this, I don't want any free shares at the time. I said I only want to earn it. So we did an over market financing with our own personal funds, which I think should have probably been the first early indicator in microcaps. That typically doesn't happen. Insiders don't typically fund themselves above market. Typically, they'll, you start by, divvying up free shares below market or at, penny shares they're referred to often. So we funded above market and bet on ourselves is what we did. Then we built the business. As I mentioned, we took insider. We just kept buying the stock back quietly ourselves, executing, spending no money in IR. We started, assembling the assets in the portfolio that we wanted. And then since then, I think, when we first started, we were at 250,000 a quarter in revenue. System sales last quarter, I think we broke 8.5 million. I think we were about just around 2.5 million in actual realized revenue, beyond the system sales. And so I think we've had now 10 record quarters in a row. We've only ever done above market financings. We were at, I'm going to say 15 cents when we funded at 20. Then the second time we were at about 10 cents. We funded at 20. Then we were about 15 cents. We funded at 30. We were at about 27, 20, 29 cents. We funded at 50. Then we had our first, that was a private family office, very strategic investor came in. Then we were trading about, I'm going to say 47 cents to 50 cents, and we funded at 50 cents with K2, a large fund out of Toronto. And then recently, we were trading at about I think around $1.20, and we funded at $1.50 on an equity round. Through one of our strategics, came back in and supported us again. So we've been, we said early on, we don't want to make money unless shareholders make money. So when we were trading at sub 20 cents, we created what we call performance warrants. So they're at 20 cents, 50 cents, 75 cents, $1, $1.50, $2. And the only way we have a chance to buy those is we have to pay for them at 20 cents a share. And we had 5 years from the day we started this process to get to $2 a share. And if we hit $2 a share and trade there and close there that day, then they become vested and we have the right to buy them. So to buy them, our partners and I, we have to put in 5.4 million of our own capital into the company. And we have to get the share price to $2. So I asked some shareholders early on and said, hey, would you be pissed at me if we get this to $2 a share when we're trading at, 10, 15 cents, and we have the right to buy shares at $2? They're like, wait a second. First off, most people thought we were full of it when we said we wanted to get this $2 a share. They thought it was just a typical pump and dump scheme of a microcap. And then secondly, they're like, why would you do this? Like, even guys called me and said, Shawn, you're making a couple of the microcaps look bad. Like, why wouldn't you just take those shares for free? Why would you just issue them to yourselves? Like, why do you have to buy them? And why does the share price have to go to $2? And I asked some early shareholders, and I said, hey, if this goes to $2 and we get to buy them at 20, would you be pissed? And the guy's like, you're telling me if I make a 10 or 12x on my money, I'm going to be upset at you? He goes, no, you've earned the right to those shares to buy them if, you get this to $2 a share. Now, for a long time, the share price actually went down not long after we joined. And I think, because there was so much tax write-off and, I was going to say tax loss selling and people that are not part of the story, and because we did no IR and stuff like that. But the good news is that allowed us to buy shares. So yeah, like I've purchased, I think, to myself and the whole co and stuff like that, I think about maybe 3.5 million shares. But if we get to $2 a share, plus what I own, and those performance warrants, I'll own somewhere between 10 and 12 million shares. And yeah, so once I get it to $2 a share, but before June 26, we have to get it there. So then every dollar after that for me will be somewhere between 10 and $12 million on the way up. So people ask me, oh, well, you here just get $2 and then you're going to leave? Like, what are you going to do? And I said, if I own 10, 12 million shares, and assuming I'm doing a decent job and the board wants to keep me, then, no, I'm not going anywhere at $2 a share. I didn't do this to get to $2. I did this because my own personal ambitions are to get this $5, $10 a share. And when we were at about 90 cents, I highlighted this for a few people. I said, we have to 22x our share price from 90 cents to get to the peak valuation of MTY, what they were at that time. Because people were thinking, oh, is it over? Is it done? You got it to $1 now. I guess there's nothing left, right? I'm like, there's a 22x here just to get to MTY's peak valuation. And I don't necessarily believe store counts of that we want to be, I ever said, oh, I want to be bigger than them. No, I've said right from the start, I want to be better. So and I think if we are, and if we do it right, and we have 10, 15 brands, and we build this into a beast with debt-free, returning money to shareholders, driving free cash flow, I think we can be worth more than MTY. So that's why I'm here. I'm not here to, get this to $2 a share and go retire on a beach. I've already had 2 exits. If it was just about, retiring, or just going to enjoy the beach, like I can go to the beach this afternoon. You know what I mean? So head to the airport and go to the beach for a while today. It's a choice that I'm here. It's a choice that Alex and Mark are on the board. It's a choice that Kevin and Shawn and everybody's working the way we are. And since then, we've strengthened the bench dramatically. Brought on the gentleman that helped me build Mucho Burrito from store number 17 to store number 150 and recently departed MTY. I brought John DeLutis back on to, overseeing, the big part of our QSR division today. We went and got Randall, who ran Fresh for us, one of the, best operators, I believe, in Canada. So, we went and got the head of finance, head of profitability and finance for Tim Hortons, brought Gary on, as our CFO. And I tied every single one of them to the same goal, which is they had to join us first, work for 6 months before they even get any options. And then if they do, they have to price them all the way to $2, just like ours. Yep. So they didn't get anything for free. And they were like, pardon me, like, what do you mean I don't get any stock options when I join? And I asked them to take a pay cut when they joined for the first 6 months. And they're like, so you're asking me to take a pay cut, buy stock in the float alongside you. And if I do that, and after 6 months, I'll earn some options. Yes. I think they probably thought, we were, intoxicated when it was said. But, the guys that did it, they're with us today. Gary went from VP of Finance to CFO. John and Randall are on the team, and they're earning their seat at the table. Everybody around us. One of the things we did early on is every single franchisee got them to buy shares. Every single area developer of ours is a shareholder. They went in, and I believe most of those guys own 7 figures of shares each. And
wow.
So that way that everybody's vested. Because imagine if your franchisees own, ideally over time, I'd like to see if you had 300 franchisees and they each own 100,000 shares. That's 30 million shares. 30% of our float can be held by our franchise partners, our vendors, our lawyer. Every single person in our team is a shareholder. We like the old WestJet model. But I said, that's how you're going to build something very different. Because if you want alignment with your franchisees, let them be your shareholders, right? So it's not just us that gets them. That way, if we make a decision that benefits Happy Belly, our shareholders win. And I think if you look back, I don't think every single franchisee of MTY today is a shareholder. It's impossible. They have 7,000 stores. Yep. And imagine if every one of their franchisees owns stock. They have 24 million shares outstanding. The entire float would be owned by MTY shareholders, right? So I went back and said, if you're going to do this differently, what can we do differently? Get everybody early on to be a big part of your success, your franchisees, your employees. Like if you look at it, I hear it from the guys at the Rosie's team. Every single week, their staff are taking money from their paychecks and they're buying more stock and Happy.
That is amazing. And these are people that might be in university, might be in college, and they're looking at their brokerage account and they're getting wealthier by the day. Investors who have stuck it out, held conviction, kept on buying shares. Your share price was, I think, like 8 cents at the end of 2023. And you mentioned there's a lot of tax loss selling, a lot of people just turning in their shares, right? Just saying, okay,
it was whack-a-mole back then. You put it down, it was getting hit at 8 cents.
Yeah, but it's gone from 8 cents. It's one of the greatest turnaround stories. And it's built on a strong foundation, obviously, and real growth. It's approaching that $2 mark. quickly, right?
And that's where the earn out gets really good for me. Like, I was very transparent about it. People say, why here? What are you doing it for? No, I'm not doing it for charity. You know what I mean? I'm doing it here to make money. But I also, this time around, I wanted to make a meaningful amount of money for the little guys. I wanted to do this and say, every franchisee gets to win. Because the first 2 exits I had, franchisees didn't get to win in that exit, right? So this time, everybody gets to win. Every one of our partners that we've done a JV deal, every single one of them have stock. So they're very aligned. They know we're all aligned. We're all rolling this thing together. And I said, could you imagine if you get this to the point, and then if you don't do any dirty financings along the way, and you don't let people in with bad intentions, right? You build this to $2 a share, cash flow positive with no debt, and earnings per share positive. The institutions where are they going to go? Because I say this sincerely, is there more upside in our share price, which I think, to your point, I think when I checked, yesterday and this morning, we're up about 1,200% since that, that started. And we still had a 18x or 20x to get to the point of MTY from where we are today, which is kind of crazy. That you can create a lot of money in that way over time, and the little guys, the little retail guys that are in here from 8-10 cents and took a chance on us, they're the ones that are going to get to sell to institutions and sell to big retail at some point and make life-changing money because they bought it at 8 cents. Most of them today, if you told them there's a 10x here with 8-10 cents and it goes to $1, people would have thought you were lying. Like, it's crazy. Not everybody in their lifetime of investing gets to experience that.
It's so true because there's so many people who have been burned by microcaps, right? By just bad management, just borderline fraudulent, actual fraudulent activity.
Because the governance on a lot of it, you basically, for a lot of it, self-governance. Because if you don't have that in you to do it right, there's so many opportunities, in my opinion, in the public markets to self-profit and not do right by the little guys. They're the last ones to get the information. So people ask me, like, why are you so open on social? And why do you do that stuff? And I say, because I want the little guys to have access to the information as quick as the big guys. Like, nobody gets better access to me because they're an institution. Oh, someone said to me the other day, maybe you should do this and bow down to the institutions if you want them to come into your store and into your flow. And I said, look at MTY today. 22% of their shares are held by institutions. I believe that is down over time, but still, it's 22%. So you cater to 22%, or you're going to cater to 78%. I said, you guys got this thing like backwards. The institutions will come in when you execute. Well, we've had 10 record quarters in a row. We have virtually, next to no debt, and you flipped earnings per share positive, and your growth story. Today we have, I think, 420 stores still in our pipeline, which could generate, on those alone, could generate $25 to $35 million a year in royalties just by opening those stores. I think we're fine. I think the institutions will come in. I've been meeting with institutions now for about the past 12 months. So, and yes, some of the biggest holders of the other QSR brands in Canada have called. Some of the big guys have delivered negative returns for the last 5 years. And, we're up 1,200%. I think at some point in time, I don't have to say anything. Our execution and our track record is doing the talking for us. And, I watched a gentleman who was on the other day, Mr. Rochon, he was on, and you did that interview with him. And you do the math of how long he's been a shareholder and some of that, look back, he's been an MTY shareholder since $8 to $10 when I did the math based on when he bought his shares. And yeah, great. He rode it all the way to 74.50, but since then it's gone down to mid 40s. And, so his return on that investment for the last 5 years has been negative. We are a growth story. We're disciplined, and we're trying to be a long-term compounder. When Stanley started MTY at 10 cents and took it to 74.50, I believe he created a significant amount of wealth for a lot of people. And that's an amazing story. Up till 2019, we want to be the next version of that. We want to do that. Look at Fairfax. Fairfax, even for a long time, I think Prem was under a lot of pressure. His stock was flat for years. And then all of a sudden, took off again. Like he stayed true to himself, and love him or hate him, he still did it and didn't change, and he grew the business. And his share price, the shareholders that stood with him have been rewarded. Yes, our share price sucked for years. It was painful. I felt like we were skiing uphill. I thought it was brutal. Like it was literally whack-a-mole. Every time shares came up, they just got hit, and they got hit. Now, the good news is I can call up shareholders today, outside of our insiders, that own between, and a lot of them, that own between 1 million and 7 million shares each. And they're personal friends, personal people I know directly, strategics that bought up, a massive chunk of the float. I think when we pulled the numbers on the recent numbers, when Shawn ran them, we had something like 50% of the float was held by 28 shareholders.
Wow.
Yeah. So the float has become incredibly tight over time. People that trusted us, believed in us, and now they're getting rewarded for that patience. Now is the next phase of the company. But don't look for us to do anything different. Like, we're not going to do IR. We're not, paid IR. We're not going to do a massive deal. Early on, guys were like, I think, Shawn, we need to go do a big deal, like make a big splash, take on a big deal. We explored opportunities for debt facilities, $20 to $50 million. And at the end of the day, we didn't do any of them. We went back to what we know, and we created value for shareholders with low risk and low debt. And so far, we've been rewarded for it. So, we're sticking true to it. But I think it's starting to stand out to people that understand what Constellation was early on, what Boyd Auto Group was in Canada. I think, and MTY, I think put them up with Couche-Tard as probably the best compounders, best capital allocators
Absolutely.
in Canada. And I think if you look at what we're trying to do, when you talk about being good stewards of capital, compounders for long periods of time, we have 400 more stores to open. Even if we never did another M&A deal again, we will do more M&A, but we're actively trying to do that. We have a pipeline of M&A, but if we did nothing but open up 400 stores, we will outpace the growth of, our direct competitor by far over the next several years. They're going to have to go out and spend massive money to buy more. You know what I mean? Stanley used to finish off every one of my sentences with, and buy more. I'd say, we got to grow more, let's open more. And he'd go, and buy more. And he'd smile because he was really friggin' good at it. So that's why he did it, right? So like, I can't blame him, but we're trying to do it the other way around. And so far, it's worked.
Francois might be watching this right now because investors like Francois, other investors, institutions, they see the path to profitability. Profitability is almost there. It's on the horizon for Happy Belly. And where else do you invest in, Canada fast food QSR growth story, right? It's Happy Belly
we're
right
actually
now.
liquid. We have basic debt free. I think we have at the moment 14 restaurants under construction. And if you do the math on what they equal, like per store, we just need to open stores to get us to earnings per share positive. Both of our divisions are already EBITDA positive. It was just now the parent co. And as we generate more profits and kick more profits and revenue up to the parent co will flip cash flow positive imminently. And we have a direct line of sight on earnings per share positive. So to your point, yes, we have a higher risk profile. And yes, we have a higher forward earnings number, but we're a real growth story that is disciplined and, is becoming predictable. And I think that's where the multiple gets higher, is because we have a very predictable growth story in 2025. I think when I ran the numbers recently, and I've said this publicly, our 2025 Q1 is going to be, for growth of net new units, is going to be up somewhere between 500 and 1,000% over 2024. So you can't help but, grow. Like, I could take most of the year off this year and we're still going to grow even if I don't work the rest of the year. So that's my honest opinion. I could take the rest. I could
and you're absolutely a visionary, right, Shawn? Like, when you first met the other Shawn Moniz, you bluntly told him that, the fresh veggie, fresh salad concept is not the growth engine for the company. And we've seen that with Freshie, right? It just didn't really work out. So why is that? Why can't, fresh salads be the growth engine for the company?
You know what? Like, hey, you may eat clean and, and healthy, 3, 4, 5 days a week, but when you want something, and a lot of times you might have that at home. Sometimes you have a salad at dinner and trying to appease your spouse or whoever, your kids, show up here eating well and clean. Look at that. But then there's other days where I'm like, no, I want a burger, or I want steak, or I want something.
And that's most people, right?
If I want it, I want a friggin' good one.
Yeah.
So if I'm going to go off of the rails and go outside of what I'm supposed to eat, I'm going to go that side. And And that's where people show up at Rosie's. People show up at Joey Turk's, our Caribbean brand, and they go in and they just want good food. And there's no other explanation for why, other than the changes and the people and stuff, how they've done it at Rosie's, that you can explain the same store sales growth. You can't. There's no, it's impossible. If you look at today in the emerging category, you got in the United States, Dutch Brothers, Cava, Chipotle, Sweet Green, probably the Shake Shack, right? And if you look at the last quarter, all those guys had positive same-store sales.
Mhm.
Well, why would they have all positive same-store sales yet? A couple of the other bigger brands or MTY had negative same-store sales. Well, the emerging categories are growing. That fast casual segment is on fire. So if you're a leading emerging brand, you can do that. You're going to grow net unit count and you're going to grow same-store sales. That's how you identify those early targets, to your point. And that's what I'm literally on the road, 5 to 7 days a week doing the belly check. That's what I travel to Canada. I'm in the US with meetings. So once we find great food and great people, then we thanks to Fairfax, we stare deeply at the unit economic model. And if we believe that it's scalable and if you touch a brand, you have to look at it and say, can this brand become a $50 to $100 million brand? Because one thing that we want to do differently, I never want to be MTY and have 99 brands. I think that's like trying to herd cats, in my opinion. You know what I mean? It's a hard thing to do. We might get to 10, 15 brands, and I'd like to always rotate probably in 10, 15 brands. And over time, if we get one or two breakout stars that get to, 50 to 100 stores and they're growing and the same store sales are there, and one thing people don't look at is the sum of the parts and the true valuation of the company. They only look at revenue whenever they don't understand the true asset value. So there may come a time where one of our assets might be a disproportionate value of our market cap.
Mhm.
And we might say, you know what, we're going to rebalance basically, and we're going to sell one of those assets. So what happens down the road if we all of a sudden sell one of our assets for $20 to $50 million? One of them, all cash sale,
Mhm.
we bring that money back in and we're already debt free. Ideally, we will do that over time, rinse and repeat. We'll go find another emerging brand. We might take 50 to 90% of that money, buy back the float, put 10% of it back into the treasury, and do it again. That's really the vision we have for the company. I don't want to scale and just get to 99 brands or 100 brands. I'd rather be smaller, more nimble, and reinvest the cash flow into emerging brands. So once we get it to scale, 50 to 100, million in system sales over time, maybe you'll see us sell one. When I see brands in the United States selling for 30 times forward earnings, if we can buy them for, let's say most of our deals have been done between 3 and 6 times. If we can buy them, double the EBITDA, scale it, then maybe that's where our greatest, time value return is. And then we sell it. So there are some similarities to us on MTY, but there's also a lot of differences. And I thank Fairfax and I think watching what Blackstone has done and stuff in the category. One thing, if you would have paid me to read as a kid, I wouldn't have done it. One thing I do every day today, I read for hours a day, and I'm, learning and trying to, take those experiences and take what I'm, the information as it comes in, process it, and go out and execute, and including the next emerging concepts. Like I hear about a concept and I validate that the numbers are great and the food's great. I'm on a plane like immediately. You know what I mean? I get in front of them and I'm trying to find what's next. So yes, very lucky they've got a great team behind me and supporting me and able to do that. But I'm out there finding the opportunities. How do we execute on it? I identify the plan, the people plan first. I think if you found Fairfax a long time ago, when Prem found that deal with buying Recipe, first thing he would do is call up Bill Gregson. He goes people plan first. Hey, Bill, I need you to, Paul and Prem would call up Bill and say, we found this asset. I need someone to run it. Same thing happened when IQ Foods came up. I think that's in my career, one of the best deals I've ever done in my career. You buy an asset with, $300,000 to $500,000 in EBITDA, debt free. When we acquire it, we bought it for out of pocket. I think the original soft purchase price was $85,000. So you want to talk about returning, we got our cash on that thing back in the first quarter. First 3 to 4 months, we got 100% cash on cash return. And now we're scaling it. The 4th store, the 5th store is open. The sixth, IQ Foods, is starting construction Feb 1. Shops at Don Mills and a Cadillac Fairview property. And we're actively working on more. So that deal alone was just because we were quick, nimble, able to move on the deal. It fit our risk reward profile. And now we're actively scaling it. And since we've acquired it, we're also experiencing significant double-digit same-store sales increases on that brand. So we've improved the bottom line on the brand, we've improved the top line on that brand, and now we're adding scale. So how many times over and over can we do that across the country? I think today there's north of 400 independent restaurant chains in Canada. If we only want to be 10 or 15, like, I think the size of the prize is there. And then I'd rather own, 10 or 15 brands that all have 50 to 100 stores each than I would, because we diversify our risk first off, just like Gaverny being a diversified portfolio. And I'd rather have the ability to sell one or two along the way, and return capital to shareholders.
And the story has just gotten started, and people want to follow your journey, Shawn. They can just simply go onto LinkedIn, search up Shawn Black, or go on X, search up Shawn Black, follow you, and you're posting photos and you're posting updates basically every day. The new opening of Rosie's in Alberta, right? You're posting about that. You're out there. I think Heal just opened up in Bloor West Village, I think it was.
Yeah.
And right, does that always come natural to you though? The whole like you're the king of social media. Like, tell us about that.
No, it does not. Social media is not come natural. Believe it or not, Alex, for the first 20 years of our partnership, I always say I had the face made for radio. Alex is much more the guy that is, built for TV. He could have, from fitness to everything, that's always his thing. And he's good at it. He's excellent. Does speaking events at universities and stuff like that. So compliments to him and, the genes that he has. I mean, he's very good at it and not natural to me at all. What's coming out in me is just passion. People, I got asked this quite the other day from an institution in a meeting. Final question they had for me. They said, "What keeps you up at night?" And I said, right away, excitement. I said, I don't sleep a ton. I'm always up. I'm reading. I'm thinking, what I got to do the next day, and or what I got to do that day, because I try to live in that moment every day and think about what do I got to do today to move the needle. I wake up every morning, and that's the first thing I think about. And in this situation, no, it doesn't come natural, but again, transparency. We want to be very transparent with our shareholders. So, and our partners. So, first of all, the one thing that doesn't come natural to me, the most thing is an office, a suit. I hate it. I hate wearing suits. I hate wearing ties. I'm a restaurant guy. I grew up since I was ever doing it. My grandfather was in the restaurant business. I walking around up and down the line in his restaurant as a kid. That's what I know. I know how to run a restaurant. I know people, and that's where. So there's no people there. And, there's one gentleman we had before, Lloyd Dove. Remember him? Came into the office and literally started ripping desks out and everything. He was old school, from the U.S. and made a lot of, been in the business a long time. And he said, "There's no cash registers in here. Why are you people here?" That's back when they still called them cash registers. I'm dating myself a little bit, but, and it was so friggin' true. And it's been that true all the time. Like, you want to find out what customers think? You want to find out what your franchisees think? Where are they? In the restaurants.
Yeah.
Go meet them there. Somebody wants to meet me today. Not come to my office for a meeting. You want to meet? I'll meet at a restaurant.
Yeah.
Why would I want to be with our people and our team? And that's where the money's made. It's not made in an office. People spend all their money in their office. They have this massive tower and a fancy office. I call BS on that. They're not restaurant people. They're P&L people, and we're restaurant guys. So if somebody's just looking for, suit and ties to invest in, that's not us. Like, that's not our culture. You want to find us? You find us at restaurants. Yeah,
I love the culture that you built from day one, Shawn. And when I walked into Heal yesterday, I purchased that OG acai bowl. The lady there who served me said that, like, Shawn's here every weekend basically with his family, picking up a bowl and checking in and didn't pour credit.
That's funny, because some guy, if you go into restaurants and ask them if they know the CEO or they know the company, and if they know anybody at that office, if they say they don't know them, don't buy the franchise. Don't buy anything, because like, they're not connected to their people. And I say that sincerely. Like, go visit, go talk to franchisees, go do the belly check for yourselves. That's where the information is. It's found in the restaurant. So it's pretty funny when into the stores and they say that, because It's important to me. I respect every one of those employees. I'm happy to walk in there and jump on the line, help them. I'm happy to sweep and clean and do whatever they need that day. And as well, sometimes maybe they're running short on something, and you can make the phone call, and you can have, when they can't leave the line to even think about what they need to do next, you can, you can triage pretty quickly when you see a problem on site and fix it. And that's just our culture. If you understand over time who we are. So I appreciate you doing the belly check and asking them if they know me.
Yeah, of
Not
course.
just the guy you
That's
see
part of my
on.
research last night. So if we look outside of Happy Belly, if we look at the multinational QSR, Shawn, what's the diamond standard QSR business for you, and then where you've borrowed ideas and systems and processes
Okay,
for Happy Belly?
I'll tell you when we look at a unit economic model, right? The biggest thing today, the driver is what is the sales to capex, right? So when you're looking at how to identify a great brand, the minimum criteria for us, if we're looking at a potential target of M&A, is 2 times sales to capex, right? So if the brand today, say it costs $250,000 to open, they better be doing at minimum $500,000 in sales. That's a minimum criteria.
Yeah.
You want to find something though that's really good. It's going to have 3 to 5 times sales to capex. So if it's cost you $250 to open, you want to find something in the franchise world that does $750,000 to $1.5 million in sales to capex.
Mm-hmm.
If when we find something that's 3 to 5, we start paying real attention. 2 times, no, not really that excited about it. If you find something though that does 5 to 10 times sales to capex, clear your table, clear your plate, dig in, start getting real serious about it. Because if you could spend $250,000 to open and you can do 1.5 million and up, you're reaching unicorn status in the business. And if you find something that can ever do 10 times sales to capex, which we happen to have found some, that's the holy crap moment. That's the unicorn. You hold on, and when we talk about if we have $1 to spend, where do we allocate that capital in our portfolio and our time? Our time and our capital will get allocated to the best unit economic models in the company. Specifically, like we have more Rosies coming up shortly that we're opening up corporately. We have more Heals coming up shortly. We're opening up corporately, all with free cash flow from those brands. So Yolks is opening up. The partners are opening up more stores. You're seeing that, right? Guys are reinvesting in their brands because the models are making sense. So 2 times is bare minimum. That's what we search for. So yes, it's got good food and good people, but do the numbers make sense? And can our franchisees make money? And if it's not 2 times, pass.
Yep.
Pass. And because it's not a lot of them, just so you understand, there's not a lot of them. I see people all the time. I swear it's like a puppy mill immigration scam that's happening out there. Guys have stores that cost them $350 to open, $450. Franchisors making $100,000 in profit, and the store is doing $300,000 to $500,000 in sales. They're barely buying themselves a job. Yeah, because your sales, you want your rent, we call GROC, gross rental occupancy cost. You want it to be sub 10%. That's where people start to make money. When it gets sub 8%, it's excellent. So if you get a brand that runs, 3 to 8% GROC on your business, franchisees are making money. Then you get a sales to capex ratio of 3 to 5 times. Very good. 5 to 10, just say thank you and buy more. Is what you do.
Yeah.
Because there's a reason why we've had, one of the top A&W franchisees in the country come in and buy 16 stores from us. My top Mucho Burrito franchisee that previously, in the chain, they've bought 20 Heals from us, right? Why? Unit economic model. It's not because I'm cute, It's not that. Like it's the deals work. We can provide them opportunity on real estate for growth. So they get, choice real estate, first mover advantage, and they're getting a unit economic model that makes sense. And if you can't, remember, they're our partners, they're our shareholders, right? They're the lifeline of the business day to day is your frontline team and your franchisees. So if they're not making money, well, then what are we doing here?
Exactly.
What I mean? Yeah.
So that's the strategy for the 9 QSRs. What about the 2 consumer packaged good products, of which I think you have a popcorn brand. You also have Holy Crap, I think, which is originally a like a Dragon's Den success story. What's your vision for the consumer packaged category?
Well,
Happy
you know what,
Belly.
the popcorn brand was was renting a cottage out north in the summer after we sold Burgers Priest, and was kicking around saying, what are we going to do next? And people show me this popcorn. Right, the owners of the property introduced this popcorn brand. Met the founder, super nice guy, Herb, who's also a shareholder of Happy Belly. Said, hey, I love your popcorn. You ever thought about scaling it? Why don't you have it in more stores? Why don't you grow it? And he's like, oh God. He was working full time at Bell at the time, and it was just a side hustle for him. So we gave him the capex and the assistance and support to leave Bell and make it a full time passion project, almost like they do on Dragon's Den. I mean, it's just we rolled up our sleeves, we worked directly with them on Shark Tank, and same thing, and that became our first deal ever in Happy Belly. So there was originally two assets in Plant and Co. One of them, we put a bullet in it. It was a cash burn. It was money suck in the business. It was awful. Yam chops. And then the second one was holy crap. We've turned profitable. It's debt free. So it's a slow growth brand, but but it has some growth. More importantly, it's profitable and it's debt free. So that's why we like it. We would do more in that category if we can buy based on our principles, which are typically we like to be asset light. And we prefer to be, we're looking for, a return on invested capital in 12 to 24 months. So if we can get our cash back in that amount of time, we'll do it. But if we can't, then we'll just continue to focus on growth on QSR side where the rate of return for us is just better.
How many targets would you say you have in the category of consumer packaged goods right now that you're considering?
Well, and put it this way, there's a couple of them as well that are in QSR that also cross over into CPG that we like. One of the strategies that we'd like to employ in 2025 is kind of the Brookfield strategy, which I was reading a lot on and how they've done it, and great way they run their strategy. A lot of times they'll buy a business, but they buy it to actually support and cross-sell their existing portfolio. So as the next phase of what we're doing here at Happy Belly, we'd like to acquire some assets that we can use our platform to sell into. So give them better costs, better access, better distribution by owning some of our own products and selling them and using our platform of franchises to vend into. So that's so cross selling lateral vending into is a big part of our business. So you may see us buy a QSR brand or a CPG brand that we actually buy it for the infrastructure. Because they may have their own manufacturing, they may have their own supply chain, and we use that and we sell into our own stores. So that's on our horizon, and that could be CPG or QSR.
If watchers here are to go out to their first Happy Belly brand restaurant, what's your favorite item in the portfolio, Shawn? Where should people go to start off?
If I was I have a couple. I'll tell you on a per brand basis. I'll walk into Heal and I'll get an OG acai bowl. I'll add protein and I add almond butter to it. If I'm getting that brand. If not, I'll go over and I'll get the on the smoothie side. Lately, I've been getting the Wake and Shake and I add creatine to it. That's those are two of my two top picks. If I'm walking into Rosie's today, I don't go all the time. So when I do get a double. And a double with cheese is classic for me. It's like, it reminds me of the best of the best memories of walking into a McDonald's and getting a cheeseburger as a kid, when you're getting that treat with pickles and ketchup. I literally get pickles and ketchup on mine. I love it all the time. If I'm feeling anything, Daniel created this. It's got a warm heat. It's not a vinegar heat. So there's spicy chicken sando.
I'm trying that next. Yeah.
It's actually ridiculous. It's the best one I've ever tried in the category. I'll challenge any chicken sandwich brand in Canada to tell me there's a better one out there than the spicy chicken sando. I don't believe it. I think Daniel created the best. If I'm West Coast based, as soon as I get off the plane, there's two things I do. I walk directly into Yolk's. I order they have a wild salmon smoked salmon, poached eggs Benny.
Oh,
Get it with the lemon truffle potatoes. And I get a spicy Caesar that they make because they infuse their own vodka and they do it all by hand. That is, to me, like the best dish in BC today that you can buy is wild caught BC smoked salmon, which they do in house, and it's phenomenal.
oh, you're making me
Oh,
hungry. I
yeah,
can't wait for the
that
first
eggs Benny.
yolks in the GTA.
That's right. I know, because it's the best. Like I literally, especially because I don't get it here. The old cravings that I used to get when I got off a plane in the U.S. and I went to a Qdoba or Chipotle, it's the exact same thing. When I land in BC, I go like literally GPS. Usually I like the Hastings store, but a lot of times in my hotel, if I'm downtown, I go to the Davie store. So I'm right there with you. I can't wait till they open here because you'll walk into that when we open here. You'll walk in and you'll get the, hey, Shawn and his family come here all the time. You know what I mean? Because I will, because I'm in restaurants usually, 6 to 7 days a week. And those are sort of my go-tos locally that I just, tradition. They're that I have to go to eat. And yet Rosie's and Heal from a unit count basis are going to deliver them. And then I'd say Yolks are probably going to be the 3 biggest unit count growth we have in 2025.
Yep.
One thing that's important, I think, for investors to know, last year we added 12 stores via M&A, and we, now that the year's done, I can say it, I had the final tally in, and we opened 12, so we added 24 stores in 2024. Internally, our own projections and our own goals, we want to add between 30 and 50 new units. Our target now is to get to 100 units open and 100 million in system sales. And we have a direct line of sight to reaching 100. So we already have the pipeline. We have the real estate to get there. It's just based on when, not if. We'll be 100 stores open and 100 million top line. But yeah, 30 to 50 units is our bottom line and baseline and stretch goal for the year between organic and inorganic. That's what we'd like to be. So we'd like to exit, 2025, somewhere around 100 stores. And a very different business, very cash flow positive, debt free. And then I'll challenge anybody in the country that's a public consolidator of QSRs to keep up to us.
Yeah. And so I'm going to ask this next question because it might be on the minds of the institutions and other larger investors watching this is there a plan to move from the Canadian Stock Exchange to the TSX?
Yes, there is.
Okay.
We have a direct path to that. I reached out to Nick Thadney, a good buddy who's a former CEO of the TSX. I talked to him the other day, and I've talked to him a few times about it. And we have a direct path there. One thing we wanted to do though was, like, it does cost more in legals and it does cost more in listing fees and stuff. And when you're a company early on that is like putting every penny towards the business, we were trying to make it a business story before we were a capital market story. And so the dollars, when you have $1 to spend, where do you allocate it to deliver the most return for your business? We allocated the capital to the restaurants versus the exchange and the lawyers. We lawyers can wait to make more fees and uplisting fees and stuff like that. But yes, at some point in time, from an overall governance and listing and liquidity and access to shareholders, at some point in time, yes. When we're very cash flow positive and the extra, let's say it costs us $250,000 more a year to be on a bigger exchange, because your insurance premiums might be more and stuff like that, for D&O insurance and stuff. We will get there. Whether that's 25 or 26, I'm not sure. But it's when the excess capital is available and it becomes a high priority item. Today we are liquid. We are well funded for all of 2025. We just did a financing at $1.50 from one of our strategics over market. So we don't need cash in 2025. Like we're not doing anything we're doing today. It's not here to pump the stock and try and do a raise. That's not what we do. So not saying we'll never raise money again, just saying the money we do have is allocated to growing the business. When we have a share price problem or a liquidity problem and stuff like that, and it's really time to go after the institutions, let's say when your earnings per share are positive, then we'll look at the uplisting. But yes, 25, 26, is it on our radar? Yes. Do I believe it's something that, larger shareholders ask about and talk about? Yeah, I probably get asked about it every third meeting now. Where
That's what
before,
I thought.
yeah, people would ask before, like, are you going to make it? You know what I mean? Are you
Yeah.
going to survive?
It's a good sign, right? If
Yeah,
they're asking, so when can I invest? I need it to be on the
that's right.
TSX.
Yeah, like I've had friends and stuff that couldn't even until there's a few criteria. Dollar a share,
Mhm.
$100 million market cap, that eliminate a lot of people that could not invest. So I think you've seen some movement in the share price once we, reach those two things.
Absolutely.
And then, because it opened it up to a pool of investors, and especially with people that have managed accounts. And then as well, you look at the next question is, when are you going to be cash flow positive? And it's sort of the third big box, I believe. And then I believe the fourth box, which I said was the kind of the holy grail, which is earnings per share positive. And once you reach that, I see the demand. I'm actively meeting with the largest institutions in the country, from $1 billion to the largest one I've met with is probably 150 billion. And do I think they, before, if we called them, they either told me never to call again, or if they answered, or they never called back. And before, even the same thing on M&A, when we called early on, it was like I was offering people Canadian Tire money when I offered them shares in a transaction. Now I'm getting inbound calls. Yesterday I had 2 calls with institutions. They were inbound to me, and direct dialogue now that happens with them all the time. And just so you understand, I'm asking them questions too. I want to know what their criteria is so that we can work towards it as a team to meet that criteria. Because you got to set your goals. You got to know where you want to play and where you want to be in 6, 12 months from now. That's why from an M&A standpoint and from an organic growth standpoint, I'm always working 6, 12 months ahead. So and to your point, do I have an idea when we'd like to uplist or when we think we might get cash flow positive or earnings per share positive? Yeah, I have an idea. You know what I mean? And but do we put it out there and do all that stuff just to move the share price? No. I feel very fortunate that we were able to fly under the radar for so long and I was able to buy millions of shares in the float.
Hmm.
I think I probably have 50% of the float minimum on my speed dial. And I think I probably can call shareholders that own 75% of the float if I want.
Wow.
You know what I mean? So I think the float is in very friendly hands now. The liquid float is probably, 30, 40 million shares. The rest of it is probably friendly held. And strategics are using every pullback, every dip, the opportunity to buy more. Because a lot of them keep coming and asking me. I had guys asking me the other day, would you take more money in at $1.50? No. Would you do a bought deal financing? No. Right. And I always tell guys, until we get to $2, like we are like so protectionist on this float that, it's been years in the making to get to here. This isn't, it's an overnight success story that actually took years. This has taken years of my life to get to this point. Shawn's life, the board, the team, everyone's been rowing the boat here. We were just a little more like ducks before, our feet were moving fast, but they're underneath the water. You couldn't see them moving. So now people see the share price move. They assume, oh, stuff must be happening. Well, stuff's actually been happening for years. And
Human nature, right?
it's true. If you look at the 1 year at MTY, they started that year 2022 and going into 2023 at 20 cents a share. They finished it at 34 cents a share. And then the next year they went from 34 cents to $2.50. And I have the chart here and I literally,
Yeah.
use it as a bit of a Bible. And that is a great testament, to, what happens when 2003 to 2004, they went from 34 cents to $2.50. Then
Which basically you right now, like within these 2 years, right?
that's
So
right.
this
Then
is
they
the
went to
path. Yeah.
385 the next year. The next year they went to $6.40. Then the next year they went to $12.60. So MTY went from 34 cents in 2003 to $12.60 in 2007. Unbelievable what Stanley did. Unbelievable.
Hmm.
That's a hell of a return for any investor, including himself, which was the largest shareholder, right? So, needless to say, that's what we're trying to play. We're trying to be the next great consolidator in the space, and deliver those types of earnings growth for our shareholders is what we're after. The market decides what the share price is worth. You know what I mean? And it'll be a supply and demand issue. And we're literally trying to create a supply and demand issue with shares. Up till recently, you've seen insiders. Last week, there was insider buying. The chairman was buying the week before. Our CFO was buying right before that. I was buying. So we're actively buying the stock back ourselves. People say, oh, why don't you do this? Why don't you do this? Get more people in. I said, hey, slow down. Like, we're actually buying stock ourselves. We're building the business. Nothing's going to change. People used to get pissed at me when we were between 10 and 15 cents, 20 cents. I was an idiot. I was getting called out on social because I wasn't spending money and giving guys crazy money in IR. And I was like, you understand how critical that 20, 30,000, they say, of money a month is? That was our lifeline.
Yep.
And it was our own personal money. I was writing those checks myself to keep the company alive. And then guys would say, oh, you know what? Don't worry. You don't have to pay us. It won't cost you anything. Just give me stock. Oh, so stock is free then, is it? You know what I mean? Like, let me just go print more. You know what I mean? I'm sorry, we're not the Fed. I can't just continue to print more and it doesn't impact me personally. The Fed might be able to do that, but I can't do that. You know what I mean? Like, we have to, we're responsible for every share that goes out that door. And I know I pissed people off and probably created some gray hairs for Shawn along the way because we had to change the culture and change how we did things. But we don't give shares out for free. You either earn them or you buy them. And that's the way we play. And it's
good leadership
going forward. We're going to buy more shares. We're going to earn more. Once we get to $2 a share, I look forward to seeing all the insiders cut the checks for $5.4 million and imagine if we do that. And also there's another $5 million in treasury. You're cash flow positive, debt free. Insider ownership then at that point is, 30% or minimum. And we're growing the business at the scale we are. That's the difference, right? I think over year is, can we become that predictable growth story for the next 3 to 5, 10 years? If we do it, like it took Stanley 24 years to get to 9 brands. We did it in 2.5 years, right? So we're using the same path, the same playbook. Just, I believe we're trying to buy brands a little more strategically and based on their unit economics, how they fit into our portfolio. Because one thing people don't realize is we built a real estate portfolio more than anything. We have one Italian, we have one burger, we have one Mediterranean, we have one breakfast. Because why? When landlords come to you, the average part, I say this as a compliment, most of them are lazy. They want a solution to space in one phone call. So if they have 10,000 feet, you get a phone call if you can solution the whole space. If you only can solution 1,000 feet, you're last on that phone call list, right? So, we wanted a diversified portfolio that allowed us to solution more square footage and be a priority tenant for them. Well, you've seen Cadillac Fairview and, some of the choice properties and some of the biggest landlords in there designate us as preferred tenants and give us some of the best real estate in the country. Why? Because our brands are in demand. Their consumers want them. And we're replacing some fading brands, that are out there. And unfortunately, I've had to take over some MTY units that haven't performed as well and stuff like that have closed recently. That's just opportunity for the next guy. It's next. And now we're going to go after significant growth here in 2025. So you'll see me. Yes, I'll be on the road in a lot of openings. I'm going to be in Edmonton shortly. I'm in Calgary, Vancouver. I'm back meeting with institutions in Montreal again later this month. We're not going to stop. Like, we have a mission here. And getting to $1 a share was nice. It seemed crazy to say that when you were at 10 cents, not, as you said, 7 cents. Guys, they were getting filled at 7.5 cents was crazy.
Wow.
But now, like I say all the time, we are just getting started. Add more brands. We're going to add more stores. And we're going to add more people to our team imminently and reach our goals. So 30 to 50, if we get to the end of 2025 and we didn't open the 30 or 50, please give me a call and yell at me. I'll take it. And I posted it on social the other day. When I showed our report card, I think we're up about 420% in a share price.
I saw that post.
24. Yeah. And I say that sincerely, that's the report card. If you're a CEO out there and your share price is down and your competitors are all up, then, that's a failing grade in your report card. And I don't know about you guys, but when I grew up and I had a bad report card, didn't happen all the time, but enough. It sucked and I got in trouble at home. And, there's some people out there in 2024 that should be getting in trouble. So if my business doesn't grow 30 to 50 units. We don't set some records in 2025. Please, next January, if I'm still here and they don't fire me, please call me and yell at me.
Last question to wrap up here, Shawn. This has been an amazing conversation, and you are absolutely just getting started. You're in growth mode. It's going to be a lot of fun to watch you through 2025. Last question is far out there. If you were to pick one celebrity, if you have someone in mind who you want to, the first celebrity to visit a Rosie's Burger location, who should roll up? Who should show up?
Adam Sandler.
Adam Sandler?
I
Okay.
would love to see it. I'm
going to send this to Adam Sandler. I'm going to send him the YouTube video.
He was filming in our neighborhood recently.
Yeah.
And a lot of guys got to see him and meet him and stuff like that. But at Burger's Priest, he came into our store early on when he was on a real health kick, and he would only get the lettuce wrap buns in the beaches because they film a lot of movies out that way.
Yeah.
But it's pretty funny. And the gentleman, oh God, I saw him on social last night. God, I'm having a blank. Was out last night. He was in our beaches location recently. He's giant, looks like the Hulk, but he's blonde.
Thor guy? Is it the guy from Thor? No?
So I said here, he films here in Toronto. I'd say, has a blanket on it, but he's great. So like I say, Adam was a good supporter of us early on of Burger's Priest, but I'd say he was a great guy. I'd love to see him in the stores. Kind of him and Will Ferrell.
That'd be fun, to see Will Ferrell in there.
Yeah. So
good guy.
Those are guys that I'd love to see in there. Trying the brand and having some fun with it, because Rosie's a classic brand, but if you look at the team, they're just good people, and I love it. I was there talking to Richard Jaffrey recently, the former founder of Cactus, who recently sold it. And telling them about, our two partners and being, ex-Cactus guys, and how they, he loved hearing that, former employees of his, went and created a brand, stuff like this. So yeah, celebrity, I'd say, I'll still pick Adam Sandler. I'd love to, that'd be a guy I'd love, especially when his new, his next movie comes out here, Happy Gilmore 2. I'd love to sit and, have burgers and break down that new movie with him.
I'll try to help make it happen. I'll send this to my ex and see what we can do.
All right.
Well, Shawn, this has been a lot of fun.
Thanks you very much. Appreciate your time.